Um, Financial reporting, first class, section 3, or rather intermediate level. So the first thing we want to look at is deferred tax. There are various topics that we are going to look on this subject. But when you're looking at them, I want you to look at various subtopics, or rather have these at the back of your mind. We are going to look at recognition. Recognition is what, if you can recall, back in section 3 and also in section 2 and section 1, this way you have something like elements, or rather definition. This is where they fit in. Then we are going to look at something else called measurement. And finally, we are going to look at disclosure. And for some few topics, we'll also look at an item called derecognition. So every time we handle a topic, you are supposed to consider those three areas that are very vital for the purposes of understanding each and every topic. So in this topic of deferred tax, we look at all these items. Maybe it may not be systematical, but to ensure that you understand. And a measurement, we look at two things: initial and subsequent. So in all the topics, you should have these in your mind broadly, that when you're revising, you ensure that you understand all these aspects in your mind. And recognition and measurement goes hand in hand. There is initial recognition, then under initial recognition, there will also be initial measurement. Initially, how do you recognize that item in the SFP? The same way there is subsequent. Subsequent recognition will also fall with subsequent measurement. So those are the things that you should be aware when you are learning all the topics that you are going to handle. Now, initially, for you to get an overview of this deferred tax, initially we are doing something like profit, gross sales, gross profit. We had our cost of sales, which gave us gross profit, right? After the gross profit, we did expenses, which gave us net profit. Then we did something here called less tax, 30% mostly. This is what we did. Now when we are doing all this, in the name of, we are using international financial reporting standards, but rather the accounting standards that are provided to us there. Now, but when now you want to pay taxes, KRA is going to give you some standards, and those standards, we can call them income tax act, or whatever, depending on the country that you are in. But for us, it is called Finance Act. So the Finance Act is going to guide you what is there, how you are now your financial statements is going to look like. So when it guides you, you'll find that there is a situation where this profit and this profit will not be the same. It means that if the net profit is not going to be the same, it means also the tax liability is also not going to be the same. So I always say that deferred tax is like a reconciliation between what you have in your financial statements, or rather your SFP, versus what KRA wants you to pay. That reconciliation bit of it is what I always view it as deferred tax. Let's give it an example. If you go if you want to do depreciation is not recognized under income tax, okay? But it is recognized under IFRS. Let me give you another easy one, because maybe you've not gone deeply into that. Let's say fines and penalties. Fines and penalties is a situation where you are, let's say KRA fines you for paying your taxes late, and you know that a fine is not supposed to handle it is not supposed to reduce the tax liability of a period. We also have another one here called donations. Those are also items that may cause this net profit not to be the same. Okay. Let me give you an example of depreciation. For example, I think that one we can use. For depreciation, under IFRS, depreciation, what does IFRS say about depreciation? How do you come up with the depreciation? You choose a figure of depreciation, and that is what you use for the subsequent years. You can choose 10%, 4%, 5%, 20%. You can use straight line basis, reducing balance basis. What is the problem of that? It means you can be having one motor vehicle and you are presenting it as 20% and the other person is presenting it as 15%. It means that if you're operating in the same environment, it is going to affect your profit. So to bring that harmonization between the two of us, KRA comes up and says, I'm not going to give you depreciation, I'm going to give you something called capital deduction. Capital deduction. So depreciation will not be allowed, but capital deduction will be allowed. So when in your mind, when you want to know the difference between what the accounting standard says and what the income tax says, that reconciliation in my mind is what I call deferred tax. So in short, there are two profits here. The first profit is what I call accounting profit, because I have calculated it using the accounting standards. Okay? The second profit is called taxable profit, because I have calculated it using the standard set out by the Commissioner of Domestic Taxes. Tumepata your difference. So the difference between this and this is what is going to give us something called deferred tax. So we can write something. Take it. We say unaweza sema income tax comprises of income tax comprises of income tax comprises of income tax comprises of current tax, income tax comprises of current tax, and deferred tax. Income tax comprises of current tax and deferred tax. You're going to first write current tax. Current tax is tax on taxable profits. Current tax is tax on taxable profits. It is tax on taxable profits. Current tax is tax on taxable profit. Taxable profit is profits determined. This is profits determined. Taxable profits is profits determined in accordance with the rules provided. It is profits determined in accordance with the rule provided by income tax authority. By income tax authority. By income tax authority. I think that is what I had explained. So there, it means then that the tax that is originating from this one is called what? What's the name we've given it? Current tax. This is what we call current tax. Okay. So we can continue writing. Deferred tax. Deferred tax refers to tax payable or recoverable. It refers to tax payable or recoverable. Tax payable or recoverable in future periods. Tax payable or recoverable in future periods. Payable or recoverable in future periods. In respect to in respect to taxable temporary differences, in respect to taxable temporary differences. Don't worry about the big terms, we're going to explain them. Taxable temporary differences and deductible temporary differences. And deductible temporary differences. And deductible temporary differences. So there are three new terms: deductible, then kuna temporary, then kuna differences. Na malumona temporary kumaanisha kuna permanent, si ndio? Na hapo kuna jina differences. Differences tayari tunaweza tukaona kuna difference. Yes. So now we need to understand what is permanent, what is temporary, what is deductible, what is payable. Those are new terms that we want to orient ourselves. But basically what we've simply explained is we've tried to define our financial statements in accordance with income tax. So maybe now we can review it and check how do we define it. How do we define it based on just 1 minute? Let me just want to add to I've explained recognition, I've explained this one. If there's a place you don't understand on this, deferred tax is one area that students normally kuna mahali wanapotezanga kidogo mahali. Ikipita imepita. Sasa afadhali uulize as early as now before start questions. Yes.
Yes, we are saying deferred tax is a tax payable or recoverable.
Yes.
How can we pay or recover it?
Yes.
Two conditions we have.
Now it is very easy to. Can I give you figurative illustrations kwa wale hawajafika, sio? Ndio muelewe vizuri ni swali gani atauliza. Let's give it figures. Nataka nipatie figures from the ladies in the room. If you're doing CPA, that one does not apply to you. I want to give you a real time so that you know what is recoverable, what is. I know we are going there, but it will also help to understand the whole these things nimeandika hapa. So tuassume wewe kama accountant, kwa sababu maisha inakupeleka mbio juu, you don't know how to calculate depreciation vizuri. You decide to use your depreciation as straight line basis 10%, or let's say 25%. Okay, you've decided to use 25 as your depreciation is 25% straight line method, and you have an asset, a PPE of 1 million. Okay, you've purchased an asset which you're depreciating at 25%. That is for 4 years using straight line method. Now, at the same time, let's say it is a motor vehicle. At the same time, KRA provides that motor vehicle is to be depreciated on a schedule that they are going to give, and they say motor vehicle is to be depreciated at 25 at 20% straight line method. So you see, you have used 25%. And KRA wants you to use 20%. When you prepare a financial statement, you don't prepare according to how KRA wants. You prepare it according to how the standards that you've chosen as your way of reporting. That's what we call accounting standards. So maybe for you, this is what you've chosen, and no one is going to penalize you for that. So by the end of the day, let's assume our profits for the year is 5 million. Let's assume our gross profit is 5 million. So let's try and prepare our books according to IFRS, first of all. So I have my gross profit, which is 5 million. Then I will less expenses. I only have one expense, which is called what? Depreciation. And my depreciation here is 25% times 1M, which is 250,000, right? So it means my net profit will be 4.75 million. Sawa. Then the question, what is my tax? My tax will be 30% of 4.75. What is 30% of 4.75? What is 30%? Inaipatia decimal points. Really? I wanted something with no decimal point. Can you use 1 million? Can you use 1 million? I don't want something with decimal points. So this is 750,000. Eh? What is 30% of 750,000? Still decimals? Ningapi? 225. So in section 1, how do we record this in the books? You have not paid it, right? So it means how will you record it? You're going to debit the P&L in short. See, to debit hapa P&L, tunaitoa. Ama niseme tax expense 225,000. Then what do you credit? Because you've not credited it, you've not paid it, itakuwa tax payable because it will be in your liability section. 225. Do you all agree with that? For if you unajua labda mwenye ako online anaweza kuwa elewi. Kama uelewi unatuma WhatsApp. Jack, hata niweke my WhatsApp for your purpose on. If you don't understand, you send a WhatsApp and say that you don't understand. Or you can even comment hapo kwa online. Utaona tu you say that area you don't understand. So basically, this is how it will look like. Because you've not paid it, but you'll pay it in future. It means then, in your P&L, I will have this, which I have already stated. But if you go to your statement of financial position and the liabilities, one of the liabilities will be tax payable of 225,000. This is what tuko sawa hapo. That's what we've been doing in section 1 all along. So now let's ask ourselves then, what will happen then if we use, this is what you have in your books. You as a person, you are willing to pay 225. You've already allocated to pay KRA 225. Now, when you now go to KRA, I want to pay you 225. KRA will tell you, wait, able to calculate, itakwambia 1 million, less expenses. Your expenses is now 20% of 1 million, and which is 200,000, right? It means then, your profit is 800,000. The tax will be based on what? 30% of 800,000, which is 240,000, right? It means KRA will tell you, wait, you are supposed to pay me 240,000, not 225. Will you start saying that I had allocated 225, wacha nikupe hii, sutalipa KRA 240, you like it or not? Because this is the amount that KRA knows. By the end of the day, the depreciation, itachukua 4 years, itachukua 5 years. And that's what very different, because it is simply a temporary difference. But if time is to be considered, the amount will be the same. Tuachana na hiyo part tutakuja ku explain. Tuko hapa. Let's try and do let us try and do this transaction. What will you do? Utaenda kwa bank. Uende ulipe bank pesa ngapi? 240,000. Question, what will you debit? What will you debit? Because you've credited your bank, what are you going to debit? Let me hear. Tuasima tujasoma deferred tax. Ndio sasa hiyo temporary difference inaingia. What will you debit? Tara kusikia.
Tunaweka kama tax payable.
Tax payable. You're sure? Sasa hapa niandike tax payable. Pesa ngapi? 225. See, for the 225 you had already allocated it. What about the difference? Where will you get it from? You realize now the difference now the difference will be a debit. Sumona. Jui pesa, the difference is what we call deferred tax. An amount of, is it 15? 15,000. Now, why do we call it an asset? Because umetumia pesa haukuwa nayo, haukuwa umebudgetia. You are going to recover it in future. Umeshika? Wewe sasa hivi nikikwambia nipatie 20,000, hauna. Alafu ujipate umelipia 20,000. What has happened? Sio pesa haukuwa nayo. So, and generally, you have acquired an asset you did not have, and you've already spent it. So I want you to view it from the point of budget. If you view from the point of budget, it becomes so easy that I had budgeted for 225, nikajipata nimelipa 240. So I had not budgeted for 15. It's like this is free money, so I have to budget it for next year. Ni kitu sina, hii ni kitu sina. Nimelipa lakini sikuwa nimejipanga kuilipa. So to me, ni kama what is happening to me, I am planning to finalize my expenses in 4 years hapa, but KRA wants me to do it in 5 years. Tunaiona? KRA wants me to do it in 5 years. So na allocate pesa mapema for the payment of those amounts. Is it making sense? How it's making sense? Is it answering your question? Not yet.
Hapa sahi hapa nauliza, for example KRA wanatudai 240 but we are budget of 225. We are supposed to be adding another 15,000.
Technically ni KRA iko na pesa yako 15.
Aje sasa nini nyonya?
Ukiapproach na hiyo level utapotea. Unaona? Si ndio tumeanda budget. It means KRA ni kama kwa akili yako you've paid them excess money. You've paid KRA excess money. You wanted to pay them 225, ukawalipa 240. So nika prepayment. Wewe kwa akili yako nika prepayment. I have prepaid them. So what happens to prepaid expenses? Next time ukienda tuseme umelipa rent. You are planning to pay this rent of this room 200,000 a whole year. Ujipata umelipa 250,000. What happens to the 50? See, it's a prepayment. It is an asset. Yes, the landlord will not return to you the rent. But what will happen next year? You will not pay 200 again. You're only going to pay 150,000. So why do you call the 50,000 an asset? Because you have paid excess than what I had planned to pay. The moment you pay excess than what you had planned to pay, we consider it an asset. The moment you pay less, you normally consider it a liability, right? Because it is now accrued expenses. Usifikirie in terms of in terms of I think if you think in terms of accrued expenses and prepaid expenses, it becomes easy for you. Because you're planning to pay 200, then you pay 250, it means you've prepaid your expenses. So the 50,000 becomes automatically an asset. So the 50,000 is going to appear in your current asset. And that asset, now in our situation, we had planned to pay 225. We paid 240. It means we prepaid our amounts by 15,000. Then if we prepaid by 15, then that item will appear as an asset. Tutafika hapo pole pole, sawa? But I hope it is inaenda ikikuwa safi. Uko salama hapo? David? Yes. Ina make sense? Kama ulipotea vile tulianza kuandika. Itaingia tu. So tuandike the accounting profits are determined in accordance. Accounting profits are determined in accordance. Accounting profits are determined in accordance with accounting principles and standards. In accordance with accounting principles and standards. Full stop. Accounting profits usually differ. This differ is not deferred tax. Accounting profits usually differ. This differ. To say differ and deferred tax. Usually differ. I'm a difference. Usually differ from taxable profits. Due to two reasons. They usually differ from taxable profits due to two reasons. Number one, they usually differ to taxable profits due to two reasons. Number one, permanent differences. permanent differences. You can say something about it. Permanent differences. You can say. These are differences brought about. These are differences brought about by items. These are differences brought about by items in the P&L. Differences brought about by items in the P&L that are recognized in the computation. That are recognized in the computation of one accounting profit and not the other. Of one accounting profits and not the other. That you find in one side but not on the other side of the profit and loss. I always say that when next year we're going to have a revision of the CPA syllabus, and I always suggest, why should we teach deferred tax before teaching taxation? Something like deferred tax should just go back just before taxation. And in section 4, financial reporting in section 4, tax in section 3, because this topic makes sense if you already learned something to do with taxation. Now, if you are doing taxation, or maybe they take it to section 2, I don't know. But if you're doing taxation, you'll realize one thing. There are some expenses that we, according to IFRS standards, they are allowed expenses. But when you go to the Commissioner of Domestic Taxes, he will tell you, I cannot allow those expenses to reduce your profits. One of them is fines and penalties. Fines and penalties, we always say, what's the basis of recognizing expenses in our P&L? The main basis is this: is that the expense must be less than 1 year. We always state that the expense must be related to the selling of goods and services, be it directly or indirectly. Okay, that's what we normally say. And it must be there for the aiding of selling of those goods. But now you see, fines and penalties, it is there. Why? Why is it there? Because that is a cost which is originating from our buying and selling. Maybe we did something wrong with our goods. Maybe the goods had issues. Maybe we paid our taxes not in time. It is going to lead to fines and penalties. According to IFRS, the fines and penalties they reduce our profits. But according to the commissioner, they do not recognize fines and penalties. Something else is profit from disposal of PPE. IFRS recognizes profit from disposal, but this guy, KRA, does not recognize profit from disposal of PPE. Something else is donations. If you donate to charitable organization, is allowed. KRA tells you, how do I know that person is a charitable organization? That person must have something to prove to me that he is a charitable organization. So he must be registered with KRA that he is a charitable organization, and he has a certificate to show that he is a charitable organization. So KRA will not separate it into two and say he must be a registered charitable organization with an exemption certificate. The other one here again will say non-registered charitable organization. They do not allow for non-registered charitable organization, but they allow for registered charitable organization. So what does it mean then? It means then that by the end of the day, this permanent difference will never give rise to temporary difference. Will never give rise to deferred tax. Why? Because you will never recover that money in future. Those things will never change. Where was I? What did I say? From the other. and not the other. E.g., fines and penalties. Fines and penalties. Donations to charitable organizations. Donations to charitable organizations. And 3, profit or loss. Profit or loss on disposal of PPE. Profit or loss on disposal of PPE. So that is the first thing. That's one of the things that's going to cause a difference between the two. And you say that the one difference will not lead to temporary to deferred tax. It means in the exam situation, if you find yourself that one of the items being provided is they donated some amount to non-charitable organizations, it is included in the P. Do not include that amount in the calculation of your deferred tax because KRA will never allow it. So, do not include it. So, we're going to look at such example. NB, permanent difference. NB, permanent difference do not give rise. Permanent difference do not give rise to deferred tax. Permanent difference do not give rise to deferred tax. So you go to number 2, temporary differences. Temporary differences. So temporary differences. Temporary differences. These are the differences between the carrying amount. These are the differences between the carrying amount of an asset and or liability. These are the differences between the carrying amount of an asset or liability and its tax base. And its tax base. And its tax base. So there's another new term there. The new term is which one? Tax base and carrying amount. Tax base and carrying amount, okay? We are saying that the difference of an asset or liability in its tax base, that is what is that. But now, we ask ourselves then, what is a tax base and what is a carrying amount? And where do we look for this? By the way, the easiest way of looking for deferred tax is when you're looking at the statement of financial position. That is like the end product of everything we are doing. Because what's a financial position states what you're left with. You know, sometimes these things in section 1 are not very easy now. But the answers are in a sound definition. Not really definition, but why are you preparing the notes? When we talk about deferred tax, talk about SFP, P&L account. Let me call it that. When we talk about SFP, statement of financial position, cash flow. What is the purpose of profit or loss? Statement of profit or loss? The general purpose, I don't want the definition. What does it show? It shows whether you made profit or loss. So generally, it shows the main activities as to why the business was formed. Because you know the business was formed to make profit. This will show you what you did. What you did within the year. Okay? SFP will show you what you are left with. What you are left with. Cash flow will show you where your money is. For example, the cash flow. Ulikuwa unafanya nini mwaka yote? Niendelee. Umebaki na nini kwa mkono? SFP. It means nikienda tu na umebaki na nini kwa mkono, naweza jua nini unafanya
Imopata. Sio ni very nikikupata Kisumu. Sitajua probably ulipata gari ukaenda ukapitia hii route. Na hiyo process ya kupita hii route ni pia ndefu. Ukifika Kisumu SFP. Umebaki na pesa ngapi? Ama pesa ilikimbiaje kwa mkono yako? Cash flow. So it means most of the time the examiner will give you SFP and want you to prepare deferred tax. Because he knows that with the SFP you can be able to know what we did with our money in the P&L. Okay? So I want us to look at various aspects in when we are defining P&L. Let's define first of all those items. Tax base is the amount attributable to an asset. This is the amount attributable to an asset or liability for tax purposes. For tax purposes. So it is the amount attributable for future taxes. That's what the tax base is. Carrying amount is amount which an asset. This amount which an asset or liability is measured. Is the amount which an asset or liability is measured in the statement of financial position. In the statement of financial position. Generally, sitaki kuongeza hapo niseme using IFRS. Ukishasikia tu statement of financial position, it means then we are using IFRS. But when we talk about tax base, we are saying how much tax is it attributable in future? Is it subjected in future? You're going to look at examples of them to bring out the clear definition. But I always say this, if I was to prepare my SFP using IFRS and my SFP using KRA modes, now I'm going to go to vehicle. For example, in our portion, in the first year, what is the net book value? 1 million minus 200,000, which is 800. Yes, serious, 800,000. But what is the other side? It will be 1 million minus 250 from this 750,000. So this one, I will call, which one is which one? No, this is 250. And this one is 200. So I will call this one carrying amount. Why? Because I have used IFRS. I will call this one tax base. Why? Because I have used KRA. We'll show a difference. I show a small table to depict what you just said. It's not messy. David, is it messy? Does your brain comprehend what is going on? Or things are getting messy? So I want us to look at some of the items and define their carrying amounts and their tax bases. You can start with what? PPE. What is the carrying amount of PPE? PPE includes property, plant, and equipments. What is the carrying amount of PPE? In section 1 we learned, although we are not using the same term, we say it is the net book value, net book value, which is calculated as cost minus accumulated depreciation. It is a net book value calculated as cost minus accumulated depreciation. Or sometimes we normally use revalued amount. That is what we define as the carrying amount of PPE. So you are all conversant with that one previously. We are all conversant with that. Cost minus accumulated depreciation. But when we move here, it is written down value, which is calculated as cost minus accumulated, let me call it capital deduction. We have nothing called revalued amount when we move to practice. We can use various terms. We can use capital deduction, we can use investment deduction. Sometimes called investment deduction, depending on which kind of item are we talking about. ID. So when you go to inventory, how do you value inventory? At the end of the year? It is calculated at the law of inventory is calculated at the law of costs or net realizable value, while the other side it is calculated at cost. We don't have anything like revaluation as far as KRA is concerned. It is simply at cost. The other side is simply at cost. We have goodwill. It is the cost minus impairment. Zero's cost minus impairment. I think we'll be doing goodwill substantively in the next two topics. This is cost minus impairment. Sometimes you can use fair value. So you can say it is cost. You can say net book value, which is cost minus impairment. Come and purchase goodwill, then I can substitute the word impairment with what? Amortization. We're going to look at that broadly. Or sometimes you can use revalued amount. But goodwill is not recognized for the purposes of taxation. Because how do you goodwill? Goodwill is something, it is a thought. I would say goodwill is a thought. Goodwill is simply a thought. How does goodwill come up? It originates from you giving value to something that originally did not have any value. So that's why I always think of it as a thought. That's why you don't sometimes have it. intangible assets. Intangible assets. Tangible assets. So the cost minus accumulated. Accumulated. Do you call it depreciation? What do you call it? Amortization. Oh, depreciation, amortization. Or revalue amount. That side will be amount not yet allowed for tax purposes. Yes.
One of the intangible assets, tunasemaga goodwill.
Except goodwill, you can separate. But this intangible asset is what you acquire in the normal course of business. For example, trademark. Now, as I'm not trademark, I know trademark is not goodwill. Goodwill is if you have 5 chairs and each chair is costing 1 million, automatically I'm supposed to pay 5 million. But you find yourself willing to pay 7 million. So the excess of the amount of the fair value of the assets or the amount you pay is called goodwill. So the same way, one of the shares might be trademark, okay, which is also 1 million, so maybe in 6. But you're willing to pay 6 million for assets that is worth 7 million. So goodwill, you cannot purchase, you cannot identify it in the assets. In such a way that if the assets are removed, you cannot identify it as goodwill. Ati hii ndio goodwill. Goodwill inakuwa tu mawazo. Unasikia jina yake goodwill. Nia nzuri. Ni nia nzuri uko nao na hiyo biashara yako. Sasa uko na nia nzuri na biashara. KRA does not allow nia nzuri na biashara. Kama nasema kama hatuwezi iona hatuwezi tukaitambua. Aya debtors. How do you want debtors? Debtors is also a financial assets, but because of its uniqueness in time, module will be looking at financial assets. Tulikuwa tunafanya aje? Total debtors minus bad debts minus provision for while on the other side, it was simply total debtors minus bad debts. Total debtors minus bad debts. So those are simply examples. There are more than 10 others that I don't have to write. We'll do them in a question. But you just need to understand. And the examiner will guide you on some of these matters in an exam. We'll try to at least 4 questions in this topic so that you can understand it from there. So let's write something. Let's have a small subtopic and call it. Let's have it and call it temporary difference. Temporary difference. See? Temporary difference, TD. Temporary difference can either be. Temporary difference can either be. Temporary difference can either be. Temporary difference can either be taxable or deductible. Temporary difference can either be taxable or deductible. Temporary difference can either be taxable or deductible. So we start with the first one. Taxable temporary difference. Taxable temporary difference. I always view deferred tax from the taxable temporary difference point of view, so that you don't confuse yourself when you're doing calculation. Okay? So the definition I'm going to use it, vice versa, is now what we call the recoverable temporary difference, or rather, the deductible. 7. This gives rise, it gives rise to deferred tax liability. It gives rise to deferred tax liability. It gives rise to deferred tax liability. It arises when the carrying amount, it arises when the carrying amount, it arises when the carrying amount of an asset or liability, the carrying amount of an asset or liability is higher than the tax base. Is higher than the tax base. Is higher than the tax base. So we move to the next one, which is called, sorry, don't move to related to our. So I will say that it gives rise to the it gives rise to deferred tax liability. Similar. Deferred tax liability. Deferred tax liability. An amount of taxes. These are amount of taxes payable in future periods. An amount of taxes payable in future periods. Move to the next one. A subtopic which is deductible temporary difference. Number 3, deductible temporary difference. Deductible temporary difference. This is when the carrying amount is less than the tax base. This is when the carrying amount is less than the tax base. This is when the carrying amount is less than the tax base. It gives rise to deferred tax asset. It gives rise to deferred tax asset. Gives rise to deferred tax asset. Deferred tax asset, you define. You say it gives rise to deferred tax asset. Then we define what is deferred tax asset. Deferred tax asset is the amount of taxes recoverable. These are the amounts of taxes recoverable in future. These are the amount of taxes recoverable in future periods. As a result of deductible temporary difference, carried forward on unused tax losses, unused tax losses and unused tax credits and unused tax credit. Andika hapo NB and use tax credit, LD. In case of a revaluation gain, in case this you will just try to do it in a question. So, in case of a revaluation gain, in case of a revaluation gain, in case of a revaluation gain, tax is charged on the gain. Tax is charged on the gain as follows. Tax is charged on the gain as follows. So it is tax rate times revaluation gain. This is a situation where you can revalue an asset within the course of the year. It can make changes in the deferred tax. I want us to draw something so next time when we meet, we are simply meeting to do a question. I want us to meet for that one lesson. Next time we will only be doing questions. I think it came in last sitting. Deferred tax was there last sitting. We are going to look at it. So you ensure by the time next class ikifika, you have your past papers in financial reporting because I will be referring to it. I just want us to draw this thing. I'll show you where to use this out. Let's cut it down. This is what goes to P&L. And you see these are simply 30% terms. But we wanted to do a percentage. Don't want you guys to be confused at this stage. Because the examiner can even say the percentage is 40%. Any questions? Any questions? We are good? Questions? Is there any question? Maybe online or anything? Questions. Halo, anaweza ona online. Zinaonekana vizuri. Kuna swali? Kuna swali? So, let's give it a break. I know today you not have company law. We'll have it tomorrow. The lecturer is Satisa. It was not earlier communicated. I want to adjust the timetable today. 8 days. Your timetable is out. So I'm supposed to adjust the timetable. Okay, so by tomorrow, by the course of the day, we will shortly after online or WhatsApp. We communicate on the changes that you can make in that timetable. So, okay. So class is over. So we'll meet tomorrow for the same. Okay? That's what I've said. In the course of the day, I communicate because one part of the timetable. So.